I was reading a recent piece from Charles Paikert on the hot M&A market for RIAs and what that demand for RIAs has done to the down payments, driving them up, doubling them in many cases, and wanted to offer some additional perspective. Down payments, I would say, from our perspective at Succession Resource Group, yeah, definitely up solidly across the industry for both big and small RIAs. The RIAs that we're working with tend to be in the $5 to $10 million annual fee range and below. And at that size, yeah, frankly, almost a third of our deals last year were all cash. So pretty big change. What I would challenge or offer additional perspective on is the reason. Demand for RIAs has always been strong. Right now we're looking at 45 buyers for every seller, and that's a nationwide average. In many states, you're looking at something closer to 100 to 1. There's a ton of demand, and there always has been. From our perspective, what's changed the down payments here in the last 24 to 36 months has been the availability of bank financing. Yeah, the article talks about deals back in the early 2000s that were 20 or 30% cash down, the balance seller finance, but that hasn't been happening in 2, 3, maybe 4 years. That deal still happens every now and then, but it's the availability of bank financing now. And not just banks that will lend, banks that are specifically going after the RIA space. They're cash flow, goodwill-based lenders, and they've taken the time to get to know our industry. It's them lending money at really attractive rates and on, more importantly, a 10-year financing term, 10-year amortization schedule. That's been the biggest driver, frankly, of practice values increasing and the down payments going up. It's the fact that you as a buyer, instead of bringing 20 or 30% of your own personal capital to the table and then financing the balance over 3 to 5 years on a seller finance promissory note that the seller begrudgingly agrees to do, it's the fact that now all of a sudden the banks are stepping in and saying, hey, hold on guys, we'll finance 100% of the deal and we'll give it to the buyer over 10 years. Now all of a sudden you look at the cash flow on these deals, they're cash flow positive from day one. Where historically you put 20 or 30% cash down, finance the balance over 5 years. Boy, I tell you, I've done enough of these deals. After expenses and taxes, you will be operating on very slim margins. Let alone you throw in one market correction or a lot of client attrition on the off chance that happens, and you could literally be underwater on a deal. So with the bank financing now happily available from the lenders that we're seeing, and buyers being able to stretch those payments over 10 years, in many cases with no prepayment penalties, I would posit a guess that this is the main reason why we're seeing down payments increase. Frankly, sellers like cash at closing, don't get me wrong, but it's actually being driven mostly by the buyers that we're working with, where, yeah, they like the idea of mitigating risk on these deals, but there's ways to mitigate the risk even in an all-cash deal using escrow services. So I love the article. I think it is spot on from Mr. Paikert. I think there are some possible additional causes as to why we're seeing down payments up, but takeaway is, yeah, in many of these deals, you are seeing all cash at closing. But I think the main reason is because we finally have banks that have taken the time to get to know your industry and provide the capital that's been so sought after for so long.